Okay. The first section I want to talk about here is going to be term life insurance. So the first thing we need to understand about term life insurance is that it's just pure insurance. You know, there's no savings, there's nothing else going on with it. It's just insurance. And when they price insurance, no matter what, insurance always goes up with age. Okay, cost of insurance, because the older we get, the higher the risk that we're going to pass away. So no matter what, insurance is always going up over time. So when people say, oh, well, my insurance doesn't go up, they're talking about the premium. The premium is different. The premium is what you pay, but the cost is hidden inside of it. So how it works is when let's say somebody is 30 years old and they want to buy a 10-year term insurance. They want to buy a 10-year term insurance. What do? They take the cost, because the cost goes up every year. They take all this cost and then they just kind of give you a flat premium so that you don't pay the different thing every year, right? So then they just take these 10 years time and then they give you a premium what to pay, you know, for that 10 years. So they would just take an average of it. So this is like the cost for a 10-year. And then if you buy a 20-year, so that will be 30 to age 50, what will they do? They will take all the costs up to the 20 years, and then they do some pricing to give you another level premium for the 20-year. So the 20-year is going to cost more than the 10-year. If you buy a 30-year, it's going to, you know, the premium is going to be higher than a 10-year or a 20-year. Now, when you get term insurance, they have three kinds. They have one called level term, increasing term, and then they have decreasing term. Okay, so what are they talking about? What's level, what's increasing, what's decreasing? What are they referring to?
It's talking about the levels standard that it doesn't change. You think when you buy it, maybe 10 years, it's going to arrive in the same amount that you bought it.
So what doesn't change?
It only changes when it is expired and when you want to renew.
What doesn't change? You say it doesn't change. What doesn't change?
What doesn't change is that the price doesn't change.
Okay, so that's not correct. When they talk about level term, increasing term, and decreasing term, all of them in the scenario here is the premium doesn't change in all of them. So what makes them different? The premium is the same here, the premium is the same here, the premium is the same here, okay? All the way through. So what's the difference? Why they call one of them level term, one of them decreasing term, and one of them increasing term? Okay, so you need to know this. They are talking about the death benefit. The death benefit in the level term stays the same the whole 10 years or the 20 years. The death benefit in the increasing term goes up over time. Why? Because some people worry in the future is inflation, so they want 100,000 to become 110,000, 120,000, 130,000. They want it to go up over time. So increasing term will go up over time. And decreasing term, let's say it starts off at 100,000, it will go down over time. So it will go from 100,000 to 90,000 to 80,000, and then by the end of your term, let's say you have 20 years term, it will be zero by the end of the 20 years. This is what they are talking about. Level death benefit, increasing death benefit. Increasing, and then decreasing death benefit. Why would somebody want a decreasing death benefit? Does it sound good? Over time, I'm paying, and then for 100 becomes zero. Why is this even something sold?
I think they combine it with like mortgage.
Yeah, so a lot of times it's to cover a debt. Let's say, for example, Prince, you come to me, you say, let me borrow 100,000. I said, okay, I can let you borrow 100,000, right? And you're gonna pay me interest, right? So then I give you the 100,000, but I'm worried. What if something happens, you pass away? Now I'm not gonna get my money back. So how can I insure my money? I can make you buy this decreasing term insurance. I can say, okay, well, you're gonna buy 100,000 decreasing term insurance. I'm going to be the beneficiary, right? And then let's say we're going to do over 10 years because you're going to take 10 years to pay me back. Okay? So now you're going to make payments on it, but as you make payments on the loan to me, the balance of the loan is decreasing. So that's why you don't need as much insurance over time, because you're paying back the loan to me. I don't need, maybe you already paid 50,000 back to me. Now I'll only worry about the other 50,000 in case you pass away. And then by the end of the 10 years, you already paid the loan to me. You owe me zero. So now I don't need the coverage anymore. So that's the purpose usually for decreasing term insurance, is to cover some kind of debt or credit or loan, you know, something like this. So which premium do you think will be higher? Yes, increasing should cost more, right? Because it sounds like a better value because the 100,000 is growing over time for in my example, right? The 100,000 here is decreasing over time, and the 100,000 here is staying the same over time. So this one, the premium logically should be higher, and the premium on this one should probably be the lowest premium, right? And this one is a level, so in the middle. So the premium is usually the way they structure, the premium is always level. But when you hear people say level term, they're talking about the benefit stays the same, okay? So this is very important to understand about level term, decreasing term, and increasing term. I don't know why people get confused. They think it means the premium. It's not talking about the premium, okay? Now, what happens at the end of your 20 years here in my example? What happens at the end of this 20-year period of time? What happens? What happens at the end of the 20-year period of time? Okay, so your term is over, right? Just like your lease at the apartment is the end of the lease, okay? So now they have some of them, they just totally expire. You cannot renew it, you cannot do nothing. Okay, but then they have another kind you can get, it's called renewable term. And then they have another one called convertible term. Some policies are renewable and convertible. You can do both. All right, what does renewable mean? It means at the end of this 20 years, when it's supposed to be over, they give you an option to renew it, okay? So now you pay this much, right here where the blue line on the top, you pay this much for those 20 years. Now, on the 21st year, you want to keep it. So how much are you going to pay? It's going to jump a lot. And sometimes it's not even according to this, you know, they give you some astronomical figure. So maybe you're going to pay $1,000 a year, for example, for 20 years, $1,000 per year. And then at the end of the 20 years, it jumps to $11,000 per year. Okay, it can jump really high. And what happens? The next year, they give you a new price. And then the next year, they give you another price. And then the next year, they give you another price. It may go all the way to $50,000 a year for this policy. Do you think you're going to keep it?
No.
No. So a lot of times when you see a term policy, if you pick up any term policy, you look at the first page, second page, it says renewable to age 105, or it says renewable to age 95. It's almost like a trick. It is renewable if you got the money to pay them, right? But most people don't have it. So people tell you, oh, I can just renew. Forget about it. You're not going to renew a term policy unless you're already dying in your bed and family really want to keep it and you're going to go any day. Now, why is it good to have something that's renewable? What's the you know, because of the premium, most people will not keep it. But why is this even an option that sounds a little bit attractive? Why? Why is this an option that even sounds a little bit attractive?
Because of the possibility of being renewable. So people don't want to take a chance if the person, like you said, is still alive or a little bit, you know, that is doing bad for you time.
Okay. So, yes, it gives you the option to renew. But the main reason why it's renewable sounds like a good idea because they don't ask you to get approved again. They don't ask you to do underwriting again. So whenever you hear renewable, you can renew and pay whatever they ask you to pay without evidence of insurability. Okay, they call it evidence of insurability. Anytime you hear evidence of insurability, it means you don't have to prove that you are insurable. Insurability. Okay, insurability means, are you insurable? Are you able to be insured? Is your risk low for us that you're not going to pass away anytime soon? You know, so people who are too obese, they are less insurable than someone who is in the right size and height and weight, right? Someone who have DUI is less insurable than someone with a clean driving record. Someone who has cancer history or heart attack history or stroke history, it's harder for them to be insurable than someone who has no health history. So the insurability is very important. Now, what's the evidence that they use? What's the evidence? You might say, I'm healthy, but it doesn't mean, really, you could be lying, right? So what's the proof that they use?
Medical checkup.
Medical checkup? What kind of medical checkup?
Taking your blood.
Yep, take your blood, your urine.
And also checking your ears and stuff on your eyes.
They check they don't really check your ears and your eyes because that doesn't usually mean you're going to die. You know what I mean? They're looking for the things that's going to affect your mortality rate. Okay? So what they can do, though, is go to your medical records. Your medical records is called APS, Attending Physician Statement. Okay? Attending Physician Statement. This is your doctor's record. So they will call your doctor's office and ask for your records for the last 5 years or 10 years, something like this. This is called APS. So this is one way, other than the blood and the urine and checking your height and weight and checking your blood pressure, you know, they come and do that in your home. But other than that, they may even go as far as getting a attending physician statement. Another thing that they use is the MIB. You know MIB?
The system whereby insurance used by investigating your health report.
Your health report, exactly. So it's kind of like that. It's like almost like a credit. It's like Equifax for health, right? So it's called Medical Information Bureau, and so insurance companies share information about their clients in this Medical Information Bureau. So based on pulling your record from the MIB, the insurance company may be able to tell that you applied for life insurance with another company last year. So they might ask you, what happened to this application you did last year? What was the result? What happened? Did you keep the policy? Did you get declined? What happened? So this is MIB. So this is another way that they look for in your evidence of insurability. So when you renew, it means that you don't have to go through this stuff again. They automatically must guarantee to give you insurance again, but you have to pay the new higher premiums that they ask you to pay. So that's called a renewable term. Many policies are renewable term nowadays because that's very popular to have that. Okay, now what about convertible term? What does that mean? Convertible term, you don't know? What is convert?
Convertible is a insurance whereby you can transfer another insurance into another one.
Okay, so Into what kind? That means you're going to change this one. To what? To a permanent policy. So all of these term life policies are temporary policies because they have 10-year, temporary. Okay. So term life is temporary. You may want to convert to a permanent. Now I heard you say whole life, right? Whole life is one kind. What is another kind? Universal life. What is another kind? Index. Index universal life, right? And what's another one? Variable life and variable universal life. Okay, there's two kinds, variable life and variable universal life. So these are permanent. So a convertible term insurance policy allows you to change your term insurance into a permanent insurance without evidence of medical insurability again. Okay, so you don't have to prove anything. Even if you already got diagnosed with Alzheimer's or you're afraid your term insurance is going to expire before you do, because some people with Alzheimer's will live another 10 years, you know what I mean? But, they want to make sure that the policy doesn't expire. So then you can convert your temporary to the permanent and they don't ask you any medical history. Now, can you convert with any company? Let's say I have term insurance with Transamerica and it's it's a convertible term insurance with Transamerica. Can I go to another company and say, hey, I have this convertible term insurance? No, you can only convert with the company, the same company. And the same company has to have a permanent policy that they allow you to convert it to. It's not any policy that they have. It has to be a permanent one that they say you can convert this to this one. Okay? Whatever they have available at the time for you. So this is called renewable term and convertible term. Any questions about term insurance? In this process here, when they ask you to pay something different every time, do you know what this is called? This one? At the end of the 20 years, they call this annual renewable term. Annual renewable term. So every year it costs more like this. Okay? All right.